In this video, I'll tell you exactly what is meant by an APR, and we're starting right now. Hey guys, Elliot here. So no doubt you've seen the three letters APR. It's right there when you talk about a loan, a mortgage, or the interest rate on a credit card. But what does it mean exactly, and why can't it just be called interest rate? Well, APR stands for annual percentage rate, and it's simply the interest rate plus any additional fees charged by the lender. That additional fee can be whatever is required by the terms of the loan, such as for example an origination, processing, or closing fee. These fees are rolled into the interest rate, and the final APR rate, which is also a percentage, reflects what you will actually end up paying and indicating the APR is required of any lender. So where did this all come from? Well, you can point to a law called TILA. The Federal Truth in Lending Act, or TILA, which passed in 1968, requires lenders to give you specific disclosures about the important terms in your loan, including the APR. They must provide this info before you finalize your loan. Since all lenders must provide it, you can use the APR to compare loans. Just make sure you're comparing APRs to APRs and not APRs to interest rates, because the two are not the same. However, knowing the base interest rate is also quite valuable. When you do compare it to the APR, you can see how much more the extra fees will add to your final rate and can use that information to see if any of them can be reduced or waived depending on what kind of loan it is. Now, when you look at an APR, don't forget the A. It stands for annual and is the rate you would pay over the course of the year. Most loans, as well as credit cards, are billed on a monthly basis, thus you need to do some basic math to see how much that actually is on the basis of a 30-day cycle. As an example, if you have 24% APR on a credit card and owe $1,000, you would divide 24% by 365 days in the year and get 0.066% as a daily rate, or about 66 cents per day. To see how much you'd pay per month on a $1,000 balance, multiply the daily rate by the number of days in your billing cycle. If it's 30 days on a $1,000 balance with a 24% APR, you'll pay $19.80 in interest monthly. However, if it's a $10,000 balance, the interest would be $198 monthly, which just goes to show that you really need to pay down credit card balances, as that is a lot. Okay, that was a quick explanation of the meaning of APR. As always, if you enjoyed this content, please do like and subscribe, and I'll see you in the next video.